Ed, we now have a market that, is kind of completed whatever we're going to call what happened in the spring, that severe correction. In fact, one of the fastest rebounds from a 15% plus pullback in the S&P 500 we've seen. What does that tell us? And I guess what does the overall market behavior suggest to you?
Yeah, Mike, it certainly has been risk on since the April lows. We went through a retesting period for a couple of weeks, but then once we got into late April, it's been very much risk on. You look at low quality stocks versus high quality stocks. They've outperformed non-dividend paying stocks, which tend to be high beta, have outperformed dividend paying stocks. The one area that usually is early cycle that hasn't participated as much are small caps, the Russell 2000, the Russell 1000. Roughly in line with each other. And so what's picked up the slack has been the mega cap growth stocks. Those were hit so hard during the correction, they've bounced back and then some. That's why you've seen the NASDAQ make a record high as well as the S&P. So this kind of behavior, again, with the exception of small caps, is generally consistent with the market trying to move higher and probably can make some further new highs in the second half of the year. Of course, there's always some more work to be done, more things to keep an eye on. But overall, the market is telling us it wants to move higher.
Yeah, I mean, I guess you can probably view that in multiple different ways in terms of, some of the aggressive post-IPO stock moves and things like that. It's interesting, though. It depends on where your starting point is. I've been pointing out that since the February peak, the previous peak in the S&P 500, earnings forecasts are higher, yields are lower, oil prices lower, the dollar lower. So it feels like it's a kind of accommodating backdrop. On the other hand, if you go back to the beginning of the year relative to what we expected then, maybe it's not as positive. So what does it tell us about the second half outlook?
Yeah, so let's go back to December when everybody was making their forecasts for the year. And versus then, I think GDP growth expected to be a little bit slower, earnings growth expected to be a little bit lower, and inflation expected to be a little bit higher. Now, there's room for the market to, I want to say, thread the needle because it's not that narrow of a path forward. There's a path forward for the market to move higher, but probably not quite as positive as it was at the beginning of the year. And there's room for upside surprises here, in particularly if the Fed goes ahead and cuts rates. When there's been long pauses in between Fed cuts, longer than 6 months, the market's done really well. So 3 months before and 3 months after, which would basically coincide with a September rate cut, the S&P's risen an average of 14%. So that's a potential upside surprise for the market in the second half.
Interesting. Yeah. And I know you've, I guess one of the debate points out there is the market's valuation. Now, typically you'd say elevated valuation means forward returns maybe are going to be lower than you would normally expect. Well, if I go back 5 years, the S&P was trading pretty much at 22, 23 times earnings. You've had a pretty decent 5-year return. So how do we reconcile these things?
Well, valuations just frankly aren't a great timing tool. They tell you where the risks are, and when the next hiccup comes to the market, these valuations probably mean that the decline will be larger than it would have been otherwise. I think that's part of the reason why you got a nearly 20% decline in just a few weeks earlier in the year. And what we want to look at here is what the tariff impact is going to be. We did some back of the envelope analysis of that. Could take about 50 basis points off of earnings. That's probably not enough to be a problem. But if it winds up being bigger than that, that's when the high valuations could come home to roost.
And in terms of what has been leadership in this market, what are the relevant characteristics of that leadership at this point? And do we expect, as long as this move continues, that will remain consistent?
Well, so far it's been early phase type of behavior with low quality stocks and non-dividend payers and the high-flying growth stocks doing well. As we move forward, I think we need to look at what happens with inflation. If it becomes more traditional cyclical, you could see cyclical value sectors start to do better, like industrial will have already done pretty well, but you could see energy and materials catch up And financials, which have started to act better as well, could participate too. So that's where the inflation comes into play, as long as it's not so much that it causes a major correction in the market. So maybe rotation from the cyclical growth into the cyclical value part of the market.